Just to get going, so just a little bit of housekeeping. So today's discussion will focus on undoubtedly a key accounting matter for the upcoming reporting season, being accounting for operating segments, cash generating units and impairment testing. The session will run for about 45 minutes to an hour with an opportunity to ask questions both at the end and throughout. So you will see within the Zoom software that there's an option to ask questions. So feel free just to type in any questions that you have during the course of the webinar, and we'll aim to get to that as we go. If anyone does have any specific questions after the webinar's concluded, please feel free to send me an email directly at alan.finnis@williambuck.com or liz.smith@williambuck.com. We'll also be distributing a copy of the slides following the session, and we'll also be able to send out a recording. So if you missed anything, you'll be able to listen again. Liz, would you like to say anything at this time?
Yeah, thanks, Alan. Yes, hello, everyone. My name is Liz Smith, as Alan mentioned. I'm a director in our corporate advisory team, and I specialise in business valuations, due diligence, and litigation support. So I'll hand back to Alan. Thank you.
Cheers. Okay. All right. So let's get started. So the first topic of conversation is identification of operating segments. So when we kind of build up from our concept of impairment testing, we kind of raise from impairment testing up to a cash generating unit, and we start off at an operating segment level. So just to give you guys a brief overview, the key accounting standard where operating segments are defined is AASB 8. And AASB 8 defines a component of an entity in the following three ways. So it engages in business activities for which it may earn revenue and incur expenses, including revenue and expenses relating to transactions or other components of the same entity. Whose operating results are regularly reviewed by the entity's chief operating decision maker to make decisions about resources to be allocated to the segment and its performance, and for which discrete financial information is available. So these are the three criteria that we come up with when we have to try to define an operating segment. Now, just to kind of go on from that before I go into some examples of how we would kind of determine what an operating segment is within our business, it is important to define what who the entity's chief operating decision maker is, because ultimately a significant part of this standard comes down to how management and the board review information. So the standard defines the chief operating decision maker as effectively the person that has a specific title for running the business. In a small business, that may just be the sole director or the CEO of the business. For a large kind of SME in the listed space, it's most likely to be the board of directors. So during the course of the financial year, the board is likely to review specific financial information on a monthly basis at their board meetings. This would usually form, something along the lines of a board reporting pack. This would then potentially display information about a specific business, in varying degrees of detail. So if I gave you an example of, say, a construction business, the construction business may have different components to it. One might be the construction of residential property. The other might be the construction of commercial property or even infrastructure. When the board sits down and discusses kind of, the results on a monthly basis of company performance, they may look at the residential division as a separate reporting kind of component. They would have their own balance sheet and profit and loss statement, and likewise the commercial construction would also have its own P&L and balance sheet, and that would be how the board would kind of make their specific decisions in relation to these areas of the business. In this kind of situation, you'd identify that you'd have two operating segments, one being the construction portion and one being the residential portion. So that's kind of how the chief operating decision makers would view the business. Over time, this can change, and it should be regularly reassessed by the board. For example, such as a business combination might occur, which might also change or even create a brand new segment depending on how the business combination has taken effect within the business. So if you go back to the example of the construction company, they may enter into building infrastructure like bridges or other kind of road construction. So then that may even lead to a third segment being created. So it does come down to a significant amount of judgment when determining how many segments that we do have. So in terms of the key characteristics to consider when determining an operating segment, there are a number of other factors to look at in addition to how the chief operating decision maker views the business. First one could be employees responsible for the segment. So you might find that you've got a business which is based in multiple locations. If I took the example of a manufacturing company that had operations in, say, I don't know, the UK, Singapore, Australia, you might find that each one of those segments has a clearly defined reporting team, which may have their own finance manager, it might have their own warehousing facilities and manufacturing capability. So in that case, the chief operating decision makers may view the business as three segments, being the UK segment, the Singapore segment, and the Australian segment. So geographical location does also come into it, and how kind of the business is managed. So they're also very common in kind of companies in Asia in particular, whereby they are very segmented up until kind of the very, very top level of the board. So you'd find kind of in those more Asian kind of style companies that they would have more segments. In Australia, we do tend to run kind of a more flatter management structure, and in terms of that, you're less likely to have significant segments. But where we do have kind of multiple locations which are operating virtually independently but controlled at the board at the top level, we're likely to have multiple segments, a segment assigned for each one of those locations. Quantitative thresholds should also be taken into consideration when defining your operating segment. So as a guideline, we tend to say, and this is also written in AASB 8 as a guideline, 10% of operations of the total business would bear consideration to whether or not we do have a segment. So say this manufacturing company that I was talking about, it had total revenues of 100 million, 50 million of it was in the UK, 48 million of it was in Australia, and 2 million was in Singapore. You might find that the Singapore entity, isn't really a material segment for the group, and you might combine that with the Australian segment if there are some kind of relationship between the two in terms of how they help each other out. You may also have a corporate segment whereby the corporate costs which are managed by the head office are held in a separate segment. So this should also be considered as part of your decision-making process. Quite often you'll see in financial reports, you'll see the key segments, which are the operating segments, and then underneath that you'll have a corporate cost allocation which will come out. As I said previously, significant judgment is required. We can help and assist with advice in this area if you do have concerns or questions. Obviously, it's mainly for a listed company space, but any kind of reporting entity who's required to meet the disclosure requirements of AASB 8 would need to contemplate this and apply it appropriately. So that's kind of the main areas I wanted to just touch on with regards to operating segments before we kind of really drill down into the nitty-gritty of impairment testing and cash generating units. And we will come back to the disclosures of how we disclose this towards the end of the webinar. So moving on to cash generating units and impairment testing. So this is an introduction to impairment testing. So it covers basically the identification of a cash generating unit and then the various impairment testing indicators and the models that are used in the testing. So the key standard here for your reference is AASB 136, Impairment of Assets. And in terms of that standard, that has everything that we required to comply with and disclose. So one of the reasons why we did decide to do this webinar today was the global economy is obviously changed quite dramatically over the past few months with the impact of the global pandemic with COVID-19. So this will be a key area of focus for organisations going forward, especially in this 30 June 20 reporting period, and it's going to become a significant accounting matter for most companies, even if you don't have indefinite life intangible assets on your balance sheet. So indefinite, just as a definition for you guys, an indefinite life intangible asset is essentially an asset which doesn't depreciate or amortize. So most common items that you'll see here will be items such as goodwill, brand names, potentially formulas, and such like, where there's no amortization charge recorded. Under the accounting standard, you're required to test every 12 months for an trigger for impairment to see if a charge is required or if we're happy with the carrying value. One of the things that people don't often always kind of realize is, whilst you have to do the annual impairment test once a year, it doesn't necessarily have to be at a year-end date. So if your reporting period is a 30 June year-end, you don't necessarily have to do your impairment test around that time. You can do it earlier on in the year. The process, it tends to be completed around the same time that the group perform their annual budgeting procedures for the year. So say, for example, your junior end management does their budgets in February for the next financial year. You might find that you want to do your impairment test in March, and that's totally fine. And it also kind of gives you the flexibility around 30 June to kind of manage more kind of operational risks rather than the compliance of this impairment test. One of the things I also wanted to touch on here today in regards to COVID-19 is there will be a lot of people out there who previously only had property, plant and equipment or other kind of finite life assets on their balance sheet. They didn't have any goodwill or such like. In a COVID-19 environment, there's potential that a trigger may exist under the accounting standards for these assets. So if you haven't performed an impairment test previously, it's something to consider in terms of how your business has gone over the past 3 to 4 months and whether it's something that you need to look at, as opposed to previously where you probably didn't fall into the requirement to prepare a test because no trigger was identified. Finally, just on for people that are going through a process of business combinations at the moment, goodwill acquired on completion of a business combination is also required to be tested annually for impairment. AASB 3 business combinations does give you the capability to have a 12-month period to finalise the fair value of your assets and liabilities. But once that 12 months window is over, you'll need to look to test that goodwill acquired as part of your annual impairment test, and whether or not there are any identifiable intangible assets in relation to that business combination, such as brand names, etc. So key indicators of impairment. These are just a few things that we've kind of gone through, and especially in the current environment, to look at. And if you do trip up a few of these, then you definitely need to kind of get on the front foot with this as we move forward towards 30 June. So market capitalisation of the business is less than net assets. So what we mean by market capitalisation, I'm sure most of you are all aware, this relates to the number of shares that you've got multiplied by your current share price. And if that amount is less than your net assets value on your balance sheet, then there's a trigger there that you might have an issue with impairment. Not necessarily always true. Sometimes the market do undervalue assets unfairly, and there's processes that you can go through to kind of get through that, but it is an indicator that there may be an issue. Continued trading losses, excluding one-off items. So if the business is constantly going through a period of losses, and that excludes the one-off items. So when we look at profitability of the business, we do add back one-off. So if there were some significant restructuring costs incurred in a particular year, we might add that back and then go from there. Failure to meet management's budgets for an extended period of time. So every year when we do the impairment test, we do look back and we assess, how did we go last year? Were we accurate in our budgeting process? And there may be genuine reasons why we may have missed or exceeded more than expectations. So it's always something to bear in mind if we have had a difficulty in managing our budgeting process. Some people as well, they may be reliant on a low volume of low number of customers. So if they get into a position where they lose a key customer, that's obviously also a risk of impairment. For a property, plant and equipment perspective, property values probably are falling, probably in the commercial space in particular. Rental yields are obviously going down, so there's a risk there, and the best way to really mitigate that is to go out to your property valuer and get their thoughts on it around the reporting date. Finally, damage to an asset. So from a plant and equipment perspective, you might be in an agricultural business, for example. You might have a piece of machinery where it's broken, and you've still got a considerable amount of written down value on that asset. and the cost of repairing it is just not worth it. So in that case, you might write down that asset down to nil. So I just wanted to just do a definition, go into now just a definition of a cash generating unit. In terms of AASB 136, it defines a cash generating unit as the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So how this kind of differs from a segment is that there may be a group of businesses working together which are largely contained in the same segment and you know, have the same kind of management team and kind of you know, a group of assets within that segment may be operating independently. So if I give you an example here, if I went back to the construction example where we said, oh, we've got two segments, we've got the residential construction and we've got the commercial construction. Within the residential section, you might have construction of high density living, such as apartments, and you might have houses. So in terms of the this situation, you might find that you've got 3 cash generating units and 2 segments, because the construction of the residential houses and the high density living would be managed by different architects, different construction teams with different kind of skill sets. So you could argue that they're independent cash flows. And then when you go and do your impairment test, you'd effectively test 3 CGUs, being the 2 residential CGUs and then the commercial CGU. Just to note there, you can't have a cash generating unit larger than a segment. So you couldn't say, okay, I've got 1 cash generating unit being the whole construction company and then have the 2 segments. So you wouldn't be able to do that under the standard. So you always have to have more or the same number of cash generating units as you do the segment. So there's 2 main value models that we use as part of our impairment testing. One is a value in use model, and one is a fair value less cost to sell model. So it's not necessary to use both of these methods. If one of them gives you a result whereby there's no impairment testing required in that your carrying value exceeds your asset base, then there's no need to prepare the other. So you might be in a situation where your value in use is generating positive cash flows and headroom in your impairment model, and the fair value less cost to sell model is generating an impairment. Under the standard, as long as you've got headroom in one model, then you're okay. So we will go through both of these models now. And in terms of the value in use model, so the value is calculated for each value in use model is calculated for each cash generating unit within an organization. As I mentioned previously, it's calculated on a recoverable amount based on a discounted cash flow model. So I'm not sure how recently you all went to university, but it's pretty similar to MPV calculation that you would have done as part of your college education. And then this recoverable amount, which has been discounted back, is compared against the carrying value of assets. If the carrying value of assets is higher than the recoverable amount, then an impairment charge is recognised. So this is how the value in use model works. And I think Liz is going to take us through now the inputs used in the model.
Thanks, Alan. So yes, in terms of the value in use methodology, it is pretty much prescribed by the standard as to how it's to be applied, and the standard fairly much says that it's not to be more than 5-year period with then a terminal value for year 5. We normally suggest that the first year in the model is based on the budgets that the business has prepared with, however, if the budgets basically include blue sky or stretch or things that are probably not that realistic, then it may not be appropriate to include them. In terms of whenever we're doing a review of forecasts, we normally have regard to ASIC policy statement 170, which talks about any forecast that you prepare have to have reasonable grounds. So we might look at things like the historical trends, or if that's not appropriate, then new customers that you've won. One thing that I think is going to make things a little bit harder for this reporting period is in relation to COVID. So obviously, just because a business has achieved a certain growth rate historically, that does not necessarily mean that that'll be a valid basis for preparing the forecasts on a go-forward basis. So there will need to be a lot more scrutiny around the forecasts that you put into your impairment models to make sure that they are based on reasonable grounds. Corporate overheads need to be allocated as relevant to the CGU. And in terms of the growth rates, similarly, it's not just the budgets that needs to be based on reasonable grounds, but any forecasts that go into the model would typically also need to be. And so I think one thing we need to all have regard to when we're doing the forecast is that we are likely to go through a difficult economic period where, you know, there's uncertainty around what the economic outlook is going to look like. So that really does need to be considered in relation to your business, and maybe even your particular customers may be going through a particular tight time. So if they've got solvency problems, just, you know, assumptions around, you know, the validity of assuming that you're always going to keep your current client base. So really challenge you to really think hard about any assumptions that you include in your forecasts. Terminal value growth rates generally is sort of done at sort of the, you know, GDP or CPI kind of growth rates. Now that isn't always appropriate. For example, generally it can't be higher than that unless it's, so if an industry is basically, for example, forecast to decline or only grow at 1%, then it might be not be appropriate to use that kind of a high growth rate in the terminal value. And the key discount factor, then once you've derived your cash flows, then that they get discounted at the weighted average cost of capital, which I'll go through in a moment in terms of the inputs to that. So some of the issues that we commonly see in when we're reviewing value and use calculations is that people do put in unreasonably high revenue growth rates. So if they've only grown at, like, you know, 3%, you know, historical years, it's not appropriate to really assume growth at 5% in the forecast period unless you've got some, you know, you've won some new clients or there's some basis for that. Similarly, in terms of gross margins, people assume that they're going to get better gross margins than maybe they've achieved historically without having some real solid basis for that. And one thing in the post-COVID environment we need to be mindful of is that just because our gross margins were a certain level historically, it doesn't mean that they will be the same in the forecast period. For example, you know, some businesses have had disruptions to their supply chain where they're having to get product from other suppliers, and the exchange rates might have moved significantly. So really analysing the validity of assuming just because we've achieved something historically in terms of gross margin, will that be able to be what the business can achieve in the future? Also potentially looking at sort of more difficult economic conditions, which mean people might have to reduce prices to get the same volume. Another issue, because people prepare them as sort of cash flow forecasts and they add back depreciation, is they don't often include capital expenditure in the forecasts. And it's probably not a valid assumption to assume that a business can indefinitely go without any additional capital expenditure investment, even if it is just replacement capital expenditure. So normally there should be an allowance for that somewhere in the forecast, and particularly in the terminal value, because that's basically what we say are the perpetual cash flows that the business will continue to be able to generate. Changes in working capital, so where growth is being forecast, for most businesses, growth requires an outflow of working capital, so making sure that that is taken into account in the forecast. For some businesses that might be retracting and forecasting to retract in the next few years because of COVID-19, that might actually produce a positive working capital inflow, which might be able to actually help with the impairment analysis. And the other thing which we'll talk about is just the discount rate doesn't not really match the risk in the cash flow. Often get asked in terms of to comment on what is a discount rate that a particular business should use, but I don't think the discount rate can ever be considered in isolation of the cash flows, because at the end of the day, the discount rate is meant to reflect the risks that are in those particular cash flows for that particular CGU. So the formula, this is again a formula as, I won't spend too much time on it, is in terms of how the terminal value is to be calculated, which is basically the free cash flows in the last period of the forecast that are then multiplied by the growth rate and then divided by the WACC less the growth rate. So that is just a formula. In terms of the WACC, so as Alan mentioned, most of you are probably familiar from this from your finance days, finance degree days. So it is effectively, in summary, just your cost of debt after tax times your percentage of debt divided by the total funding of the business, whether that be debt and equity, and similarly the equity cost of funding as a proportion of your total funding as well. So that's just a formula. So one of the most subjective inputs to the WACC is the cost of equity, because normally the cost of debt is fairly able to be reliably ascertained for a lot of businesses. So the idea behind it is using the capital asset pricing model, which is again another formula you're all probably familiar with, where you've got the risk-free rate and then you've got the beta and the market risk premium plus the alpha. So I'll talk about all of these factors that go into the discount rate in a second. So the risk-free rate is able to be gained for a particular date. It's publicly available information, normally based on the 10-year government bond rate. It can be sourced in the AFR for a particular day, and also I think on some of the government websites. The market risk premium is basically generally in Australia, we assume that the market risk premium is 6%. What it is intended to be is the additional risk, the premium that market participants tend to expect over the risk-free rate more broadly. And so that's generally not a lot of contentious to that. It's just generally accepted to be 6% most of the time. So beta, a lot of people don't understand what beta is. So beta is basically the risk that you cannot diversify from the market. So for example, if a company has a beta of 1, this means that they will generally expect their shares to move in line with the market. So as the market goes up, their shares will go up, and as the market goes down, their shares will go down. If a company has a beta of 2, then you would normally expect that the movement in their shares would be twice the movement of the market. So whether that be up or down. And similarly, if the beta is 0.5, that means that they're probably only moving half as much as the market would tend to move. So it is basically the risk that you can't diversify in your portfolio, because it's all the shares are basically on the same market. What we tend to see is companies that have high betas are those that tend to be more speculative, more volatile. So technology type companies, early stage miners. So those much more speculative, high risk investments typically have higher betas. And similarly, the more consumer staples that are less subject to things like COVID, because people are still going to be going to the supermarket all the time, regardless of what the economic conditions are, that those types of companies have lower betas. So one of the things too is the beta basically represents the risk in the equity, whereas what we're normally valuing as part of the value in use is we're looking at the returns on the actual asset. So we have to go through a process where we effectively take the financial risk element of a beta out of it. But what beta does not include is it does not include the company-specific risk. So it's to do with the movement in the market and how that company might move in the market, but doesn't take into account individual risk, which we normally add in through an alpha factor. So the alpha factor is probably the most highly debated area and highly subjective area in calculating a company's cost of equity. So there's particular things that we would adjust for and consider in terms of the alpha. So you've got the size, the stage that the company is at, and then company specific risks in terms of customer reliance, supplier reliance, location, people. And the other thing, this is where, for example, if a business is forecasting growth rates that's much higher than the industry is expecting, that we normally expect the alpha factor to consider some of the risks in the forecasts that are higher than the industry. It is highly subjective. So at the end of the day, it's probably always worthwhile, whilst there's no requirement to do the cross-check to multiples. I would always recommend that you look at the discount rate that you've effectively got and convert that to a sort of EBITDA multiple. Because if, for example, you're getting of 8, but the likely, you think your business would be only valued at 4, then it might be 4 times EBITDA. Then you'd be maybe potentially questioning, are the assumptions that you've used in your cost of equity reasonable? So the other thing that I would, as Alan was sort of suggesting, is maybe because of the uncertainty in the scenarios, and you can do impairment testing early. It is a good idea to basically start doing this impairment testing early, because if there's any idea that it's doubtful as to whether it's accurate or not, it's a good time to basically go and get that independent expert advice in relation to that. The other thing, another good cross-check for your discount rate that you're effectively using could be in relation to just going and looking at the other companies in the sector and what discount rates they might be using. But the other thing, in terms of coming back to the WACC, is what percentage you use for your cost of equity versus your cost of debt. So, which is basically the gearing ratio that you've used. One of the things that I see, a common error is that people will take the net assets position as their equity position rather than the market cap, which can end up with distorted gearing ratios. So we would normally benchmark the gearing ratios that we use against comparable companies in the industry, what they are doing, as well as the actual, because it is value in use, what the actual gearing ratio is appropriate for the company, but more particularly also for the particular CGU.
Thanks, Liz. So just to kind of tie that all together, I have put together a brief example here just to kind of illustrate kind of how this would be calculated in a value and use model arrangement. So you can see here we've got an example where we've got 5 years of cash flows based on sales starting off from year 1 of 188 million. We've got a growth rate of 3%, we've got a gross margin of 20, we've got inflation at 1.3, and we've got a terminal growth rate at 3. You can see in the model that we've obviously taken off overhead charges, we've added back our depreciation, and we've also incurred a cost for CapEx, which means effectively that our asset base is not diminishing. It's always important, especially in the terminal value year 2025, that your CapEx is at least equal to depreciation. Otherwise, when you go into the terminal year, your asset base would shrink down to effectively 0, and it wouldn't be sustainable for the business. We've also got a corporate allocation section in here as well, which is what Liz was talking about earlier. We've allocated 60%, so in this situation we might have another CGU there that makes up the other 40%, but in total we would have the full 100% of the corporate allocation. And the working capital requirement, in that this is a significant payment in year 2021, and this is likely that they're expecting a significant increase in revenues between 2020 and 2021. So to support that increase in revenue, we've obviously got a much larger working capital requirement and adjustment there. As you go into 2022 and 2023, that decreases significantly, as we're already at kind of the base level revenue. So this gives us our free cash flow at the end. So you can see in 2021, because of the working capital requirement, we've actually got negative cash flows. And then in 2022 and 2023 onwards, we kind of get our cash flows. This is then obviously discounted back by the weighted average cost of capital, which we'll show you in a couple of slides' time, which then comes back to our recoverable amount for the CGU there of 52 million approximately. So, and then when we compare this to our asset base, we look at what should be included in the asset base. So we do include working capital balances in the asset base. So that includes trade receivables, inventory, and payables. And then we also test the fixed assets and also the total goodwill. So here we've got an asset base of 48.7 million, and we've therefore got headroom of 3.4 million based on the total discounted cash flows of 52,161. So that's kind of how it's come together. And if anyone out there needs any assistance here, we do have templates and such like that we can provide. And Liz can also provide some help with actually performing impairment test for non-audit clients. So, you know, if you do need any assistance, please feel free to reach out. In terms of the discount rate, this is basically considering Liz's discussion that was held a couple of slides ago. So you can see all the various components there. So in this case, we've got an alpha of 6%, and as Liz said, that is the most kind of judgmental area of the formula. And then we've also got our beta there as well. This is a post-tax discount rate, so we've also got the tax rate there of 30%. Obviously, if it's a smaller business, you would have 27.5 in there. So then this gives us our cost of debt and our cost of equity, which then combines into forming the discount rate. So sensitivity analysis is also important for the value in use model. When completing a value in use model, we should assess sensitivity. So when we do look at the impairment models, the key areas which are sensitive to, the most sensitive are revenue growth, gross margin, and movements in the discount rate or WACC. So we look at these in isolation though. So say, for example, we went back to our example. We look at the terminal value growth rate there, or the growth rate, we might adjust that down to 2% in isolation and see what happens to the model. If the discounted cash flow here of 56,161 falls below 48,699, we have an indicator of impairment there. It doesn't necessarily mean that we have to impair, but it means that we're required to include additional disclosures in our financial report, which I'll show you in a few slides' time of how we would do that. As most of you are aware, AASB 16 has been online now for about 1.5 years, and for most people, this will be the first year end when it's applicable. So we do have to factor in the impacts of AASB 16 in the impairment model. So the right of use asset is included in the carrying value of the CGU. The rent payments aren't included in the cash flow forecast, as we're saying that they're now financing in nature and not relation to the operations. And effectively, we'd be double counting because we've included the asset in the asset base, and then to take out the rent payments as well, it will be double counting and give a negative outcome to the report. In terms of the lease that's may end during the terminal value period, so obviously the terminal value goes into infinity. The lease have a finite end date. We would assume that the lease would continue throughout the life of the ongoing, so we'd still kind of keep that asset value in the model to support kind of the cash flows, because essentially you would need to have that lease in effect, probably for a manufacturing plant or an office such like, whereby you can't run the business without it, so it needs to still be included. Liz, are you going to talk about the fair value less cost to sell?
Yes, I can do that. Thank you. So the other methodology that you can use is a fair value less cost to sell, which typically is based on the maintainable earnings. So we're determining what we think the future maintainable earnings are and multiply them by a multiple to determine basically the value of the asset pool that you need to use for that comparison example that Alan used before. In terms of, there's two key elements that you need to determine here is one, what is the EBITDA? So again, simply because it's forward looking, we'll probably largely be basing that on the budget or the recent historicals, but adjusting, in considering historicals, we'd be adjusting for what we call abnormal or non-recurring things. So as the slides indicated, there's sort of one-off gains on sales, one-off costs associated with restructurings or other things that are one-off write-off of inventory or some abnormal thing that might have happened in terms of the historical numbers. So the other element there is the EBITDA multiple that you use, which again requires subjective judgment. So when we're doing this analysis, we'd be looking at, what do companies of a similar size in the same sort of industry, what sort of multiples do they typically achieve, and what sort of multiple would we expect to apply to this business on a fair value basis. So as we're really doing a valuation of the business in this example, and different to probably when we normally do valuations, the other thing that standard requires is basically, because it is talking about effectively being able to sell the business rather than hold on to the business and generate the cash flows from it, that we do need to take into account the realisation costs, so the costs that would be associated with the sale of the asset, which is something I sometimes see people not do when they basically use the fair value methodology. You can also, just so you're aware, use a fair value methodology as a discounted cash flow methodology, which a lot of people are less familiar with. But there's some big differences in approach between the way we look at the cash flows from a fair value methodology versus a value in use methodology. So I guess the first thing is probably no restriction in terms of the time frame that you can go out under the asset under a fair value methodology, because it would be the way that the market would look at it. And if there's particular synergies that just relate to the business itself that wouldn't be available to other buyers, then they would have to be excluded from the forecasts. Whereas in a value in use methodologies, because it's about the synergies that you can use as the owner of the asset, then any of those synergies can be included. So generally, unless synergies are available to every or a few buyers out there who would pay for some of those synergies, then they're excluded from the DCF in terms of the fair value methodology. Fair value is really looking at it from a market participant point of view. So if most market participants would basically restructure that asset or do something different or enhance the performance through certain investments, then you can take that into account in your fair value methodology. However, when it comes to value in use, the standard's quite clear that you cannot include your restructuring unless that's already been committed to, or new investments unless you've actually already incurred the cash outflow. So there's some very different assumptions to where you might use a fair value methodology using a discounted cash flow versus value in use. So it's worthwhile just being aware of that as well. And as Alan mentioned before, at the end of the day, what we want to do is basically go back to a sense check on everything to make sure that the market capitalisation. So if you've got an indication that the market cap is substantially lower than the asset base, then the level of work and analysis that you should be doing if you're coming up with indications of headroom would generally require a lot more scrutiny to make sure that all the assumptions that you've used in your calculations, whether it be fair value or value in use, has gone through appropriate rigorous tests. And probably advisable in most of those situations to actually get someone in completely independent to go and prepare a report to support the decision around the impairment.
Thanks, Liz. And also just in terms of other asset valuation techniques here, there's a couple of other things that we want to look at outside of just kind of the 136 requirements, and one of those is financial assets valued using WASB 9, WASB 13. We don't touch on it so much on this webinar, but if anyone does have any individual concerns or questions on this, please feel free to reach out. Obviously, under these standards, we have the hierarchy approach, level 1, level 2, level 3. Level 1, for everyone's information, is quoted market prices. So that's quite easy to test whether or not there's an impairment charge there or not. In terms of level 2, there's kind of observable market inputs such as FX rates, property valuations in the area, such like, and then level 3, which is mainly unquoted investments, which is probably where a lot of focus is going to be this 30 June, given the impact of COVID, and it's going to be quite hard to value these investments. So if you do feel like you have level 3 investments, on your balance sheet at the moment, it's something that you really need to kind of be aware of and look into as we approach kind of the reporting season. Again, I did touch on this previously as well in regards to property, plant and equipment, and we should look to get that checked by an independent expert if we feel that we do have a trigger for impairment. So I wanted just to finish off for the last 5-10 minutes just on some disclosures. And it kind of just brings everything together and how we would present this in a general purpose financial report, either for an ASX or unlisted public company, or someone who chooses to prepare general purpose reports in the private space. So in terms of segment disclosures, the key things that you're going to need to disclose with regards to the segment disclosures are the financial information, so the revenue by segment, the effective earnings before interest, tax and depreciation, and then specific result for the segment less the corporate costs. You're also required to disclose geographical information. So this is forms the basis of revenue and assets. So revenue you're required to disclose by country or region, depending on the circumstances, and the same with assets. So we generally have a rule again with 10%. So if 10% of your revenues are from one specific country, you would tend to disclose that separately. If you've got a group of countries which make up 2 or 3% each, you could disclose those as other locations as one line, so you don't have to go to excessive detail. Most clients that we deal with maybe have 3 or 4 that they might disclose, and then another category to cover off the rest. That would also be the same for assets. In addition, if all your assets are held in Australia, but you have international revenues, you can include the table for revenues, but then for assets, you can just put a comment under saying all the assets within the company are located in Australia or wherever they may be. Key customers is also important. So if you have a customer that makes up more than 10% of your total revenue, you should disclose that separately and explain, the percentage of total revenue that one customer makes up. Even if you're in a position where you only have one operating segment, so you might be a manufacturing business that manufactures one item, but you do export, and you do have a couple of key customers, you still have to disclose that information. So you still have to disclose the revenue information, and you also have to disclose the asset location and the key customers. Assuming you've just got one segment, one manufacturing plant in Australia, again, as I mentioned previously, you just note that the assets section, that were all held in Australia. So moving on to the impairment disclosures. So when completing the disclosures around impairment, the following should be disclosed. So we need to disclose the choice of model that we've used, either the fair value in use or the fair value less cost to sell, and this should be in your accounting policies note as well. Disclosure of CGUs, including value of assets in each CGU. Disclosure of the WACC, the growth rate, the terminal value rate with prior period comparatives when the value in use model is used. Disclosure of an EBITDA multiple, maintainable EBITDA if the fair value less cost to sell methodology is used, and disclosure of sensitivity analysis when there's a close call on impairment. So if we feel, when we went back to the example previously and I said if we decrease the growth rates by 1%, we may trigger an impairment charge. In that case, we would disclose that. Whereas if we still had significant headroom, we could say no reasonable possible change in the assumptions would result in an impairment charge. So I've got an example here from a 30 June 2019 report, which was kindly allowed to be presented by the client involved, which was great. So thank you very much to those guys. And this basically gives you an example of how things should be disclosed. So here we've got 2 cash generating units, being the USA and Australian International. And then we've disclosed, how much goodwill we've got and how much we've got in brand and trademarks. We've also disclosed that we use a value in use model and that we base our cash flows on a year 1 budget and a 4-year forecast period with a terminal value in year 5. We've disclosed that we're complying with 136 and we prepare the impairment tests, and we confirm that it exceeds a recoverable amount. The second part of the slide is, the second part of this disclosure discloses the various kind of growth rates and percentages that we used. So we've obviously disclosed our growth rate, our terminal value, and our pre-tax discount rate. The standard does say that we should be using pre-tax discount rate. There are people out there that use post-tax. Based on our understanding, that is permissible these days. But officially in AASB 136, pre-tax discount rates are required. The other thing that you will notice about this model is they have done some sensitivity testing, and they've noted in the US CGU that if the growth rate decreased by 1.2%, it would result in an impairment charge, and likewise, if the discount rate was increased, it would. They've also noted separately that there's no reasonable possible grounds for the Australian International CGU to recognise a charge. So that basically means when we talk about the sensitivities, we just need to make sure that we actually disclose for each CGU as well, not just overall. So just bear that in mind as well. So that was pretty much everything that we wanted to discuss today. So if there's any questions, please feel free to either type them in the Q&A box. We can have a chat now, or If you would rather, my email and Liz's email is there, and please feel free to reach out if you need anything, help or assistance. Give it a minute or two, just if someone's typing. I do really appreciate everybody's attendance today, and I hope it was useful for everybody. We have relaunched the Financial Reporting, Accounting and Advisory division this week, so we are kind of out there now in the market, and we're happy to assist with any kind of areas which might require significant judgment or technical accounting expertise. We can also prepare general purpose financial reports for non-audit clients for listed entities, and assist with the transition from special purpose to general purpose. If you're watching this presentation today as well and you enjoyed the presentation, we can also organise specific training courses for you and the rest of your finance team, where we can come out and visit you and present on a topic that you would choose. Guys just said, yep, guys, copy of the presentation will be distributed after this, and there'll also be a recording as well, so you can listen to it again if you feel like you've missed something. So hopefully that's all good. Yes, so I think that's probably everything that we need to discuss today. Liz, do you have anything further?
No, I don't. Thank you.
Well, we'll close the webinar now, but if any